What's going on, my fellow wealth creators? Matty Ice here. In this video, I want to address the age issue when it comes to setting up an infinite banking policy. And I want to do a video on this because I'm actually working with a client right now that thought she was too old to do anything like this, to actually set up her own policy. And it was funny because we just set up a convertible term policy for one of her sons to get him some coverage and eventually turn that into his own whole life policy to use for their real estate business. But she called me the other day and asked if we could go ahead and convert it, even though we literally just got the policy approved a couple of months ago. And she was talking about converting it so that she could, again, use it for her real estate business. But it came up that she thought she needed to use her son's policy for this because she didn't qualify for her own, or couldn't, because she was too old. That's what I don't know if that's verbatim what she was told by the agent that she was working with, but or if it was assumed, because the illustration that she told me about, that the previous agent had showed her, was that she wouldn't be able to access her money for 5 years. Now, that might be a little bit of an exaggeration, because even with really bad, like 100% base traditional whole life policies, you usually have some access to cash value within 2 to 3 years. That's not usually 5. But either way, the agent obviously did not know what they were doing, what they were talking about, or at the very least, and probably more importantly, did not listen to her and was not taking into account what she was trying to actually accomplish. They didn't take the time to get to understand her goals and what she was trying to accomplish so that they could design the policy in such a way to meet those goals, right? That's why I think one of the most important things when it comes to infinite banking and life insurance, and I guess really dealing with any financial product, is who you work with, right? That's probably one of the most important factors, because these policies can be designed however you want, but the agent has to know what they're doing. And so, and they probably don't know about infinite banking. They probably don't do it in their own lives. And that's why, preferably if you're going to do something like infinite banking and set these policies up, you probably want to work with somebody that's actually utilizing infinite banking in their own lives, or, at least knows how to design policies for such a thing. So I want to talk about 4 main disadvantages of waiting until you're older to do this. But to answer the question, are you too old? Probably not. Like when you start getting into your 80s, late 70s, 80s, is it a little too late at that point, at least to implement something like infinite banking? Probably. That doesn't mean you can't get approved for a policy, though. At that point, it's really going to come down to your health, right? And eventually, I mean, you are going to be, we are going to get we can reach an age where we're too old to get life insurance, but that's why you want to be setting these things up as soon as you possibly can. So you don't want to postpone locking in your insurability and setting these policies up. The earlier you set them up, the more beneficial they are, the longer they're able to compound as well, to get tax-free compound growth, right? Very, very important. But I want to, I'm going to show you an illustration here in a minute, but I want to address the 4 main disadvantages, because I want you to be aware of them. So you're probably not too old. As long as you're in good health, then you can most likely get a policy. But there are some disadvantages that you want to be aware of. So I have them written down here. So number 1, you're going to get less death benefit. All right. Now, here's the thing. Age, when it comes to infinite banking, right, we're usually setting these policies up for high cash value that we can access within the first 30 days so that we can accelerate the wealth building process by making investments we normally would make, right? Whether that's real estate. I usually recommend some type of real estate with infinite banking, but, to each his own. However you want to build wealth in your life is totally up to you. And so typically we set these policies up for high cash value. When it comes to setting them up for high cash value, age doesn't really matter. It does make a little bit of an impact, but you can still get really high cash value policies with infinite banking when you design them correctly. And actually, you know what? Let me go ahead and share my screen. I want to show you the illustration that we just submitted an application for this client. I want to show it to you really quick, and then we'll get to the other 3 disadvantages when it comes to age and waiting. So you can see here, so she's 47 years old. All right. And basically she's going to be doing, she wants to do a large dump in the first year so that, again, she has access to a lot of cash value to use in her real estate business. And then she wants to do $12,000 per year after that. for this policy. We're going to be setting up more policies. We're actually already putting more illustrations together, but this is the first policy she wants to start with. Okay, and you can see here in year one. So she the first year she dumps in the 50,000, and look at the amount of cash value that she has access to at the end of year one. Now, within the first 30 days, she'll have access to roughly like 85% of this number, and then like 90 to 95% of this number by end of year. But because this number is after the dividend is applied for that year, but she has access to the majority of her money. And this is how you structure policies for yourself if you're trying to get access to a lot of cash value. This is not the only design you can do, but the way we have it set up is a 25-75 split. So 25% is going towards the base, and then 70 in the term policy, and then the rest is going to paid up additions. And that really helps accelerate the cash value, makes the policy more efficient. Right. And but also what really makes this policy efficient is the large dump in. That's really, really important. If you are older and you're trying to set up a policy for cash value, I would strongly recommend, I recommend this for pretty much any policy, is trying to, you want to do a larger amount in the first year than the following years. That's called a dump in, like a large upfront dump in, whatever, front load. There's different terms for it, but this basically gives you access to a lot of cash value within the first year. And it kind of supercharges the policy a little bit as well, because you're starting with a higher number. Anytime you start with a higher number, that compound growth is going to be even more impactful, right? So, and then what we did is we set this up as a 20-pay policy, all right? So she's only going to pay into this for 20 years. So at 67, maybe when she's ready to retire, maybe not. She doesn't seem like the type that actually believes in retirement. But anyways, she has that option. She doesn't have to make another premium payment for the rest of her life. Her policy is paid up, kind of like a mortgage, like you pay off the mortgage on your house. She never has to make another premium payment ever again after year 20. And yet it still continues to grow, right? So you can see here, the cash value still continuing to grow every single year. And it's going to do that for the rest of her life. So that's one of the amazing benefits of these policies. Now, the other thing I want to mention is so we're on the topic of one of the disadvantages of waiting, or if you're older and trying to set up a policy, is you get less death benefit. But that's also where the having multiple companies that you work with and having different options is really important. So we actually ran another illustration with a different company, and the policy was more efficient from an internal rate of return standpoint, but it had a lot less death benefit. So you can see here in the first year, her death benefit is a little over $1 million, which she was very excited about because death benefit is very important to her. A lot of people try to reduce, a lot of times you try to reduce the death benefit as much as you can in order to accelerate the cash value growth. But you don't always have to do that. And you don't always want to do that because the death benefit is actually really important, guys. One, it protects your loved ones financially. But two, these policies come with living benefits, chronic, critical, terminal illness policies. So if you end up getting sick later on down the road, you can access a large portion of that death benefit to use for whatever care that you want. I mean, it could be literally a lifesaver. I can't tell you how many stories I've heard about that. And so death benefit was really important to her. And this, what I told her was, look, so we have two different companies here that we're looking at, and it comes down to what you're trying to accomplish. Okay. Let me go back to full screen because we're actually, you know what? There's one other thing I want to show on the illustration here. But to finish this point, we were looking at two different companies. All right. And basically what I told her is because she kept saying that she wants death benefit to make sure, because she's the primary breadwinner in her family. She wants to make sure her family's taken care of if something happens to her. So what I said was, okay, that's great. And I love that. As long as you're willing to, if you're willing to sacrifice a little bit of cash value growth, and it's not even that much, to be honest, it's not a huge difference. If you're willing to sacrifice a little bit of cash value growth and internal rate of return, efficiency, however you want to call it, for more death benefit, then this is absolutely the policy for you. If cash value growth and efficiency is more important, then we might want to consider the other company. And she was like, nope, death benefit is, I want more death benefit, period. And we're talking about like a $300,000 difference in death benefit. So here's what's really great about design, guys, is that not only was she able to get access to a ton of her cash value, a ton of her money within the first 30 days of setting up the policy, which is what she wanted for her real estate business, she was also able to get an extra $300,000 of death benefit, roughly, just by comparing different illustrations, guys. So that's why, comparing a couple of different companies, can be very, very beneficial. And it all comes down to what you're trying to accomplish. Okay. Now, one of the other things that I want to mention too is this policy could actually be a little bit more efficient, but we put a 20-year term policy on it as well. Because again, she wants that death benefit. So you can see here after year 20, the death benefit drops off. And that's because that's when the 20-year term expires. Okay. And so once it expires, obviously that's going to reduce the death benefit pretty significantly. Right. But she still has a ton of death benefit, and we're going to be doing multiple policies as well. And that death benefit is just going to continue to grow for the rest of her life. And I can't think, just based off of, I can't think of a better design just based off of her specific goals. And just I love seeing this kind of stuff and how we can custom design these policies specifically for what you're trying to accomplish. I absolutely love it. All right. So that's the illustration. Let's go through a couple of other disadvantages I just want you to be aware of. They're not deal breakers, but you just need to know about them. All right. We kind of touched on this a little bit. Less efficiency due to higher costs, right? So obviously, the older you get, the more expensive life insurance is going to be. Particularly, like everything about life insurance is more expensive every year that you get older, but also the term policy that we have to put on top of the whole life policy in order to prevent it from becoming a MEC, a modified endowment contract, which would, if that happened, it would cause you to lose all the tax advantages of the policy, which we definitely don't want to do. So we add that term policy onto the whole life policy in order to artificially raise the death benefit so that it's not a modified endowment contract. Okay. So the older you are, the more expensive that term life insurance is as well. So that's something to keep in mind. Typically, it's going to be a little bit less efficient. But that doesn't mean you can't get approved. It doesn't mean it can't still do amazing things for you. Because one final note about efficiency is, while we want our policies to be as efficient as possible for our specific goals, setting up these policies for the internal rate of return is not the goal, guys. It's not really it's not the main reason we're setting up the policy. We're not trying to get an incredible rate of return on our whole life policies, really any life insurance policy, right? For me, it's just a bonus. These policies are typically going to net 3 to 5% tax-free compound growth for the life of the policy. The one I just showed you is about 3.18%. All right. Which for me, for a savings vehicle, is very good. Where we're going to get the real rate of return is how she's in this example is how she's going to use the policy to invest in real estate and grow her business. That's where the rate of return really is. But while she's doing that, her money is compounding in this policy. She has the death benefit to protect her loved one. She has the living benefits in case something happens to her. And she's basically now will have this really strong financial foundation that gives her liquidity and access to her money in order to build to grow her business while she still has all these amazing benefits. So I love that. So if, when you're older, these policies will typically be less efficient just because of the extra higher costs associated with it. Doesn't mean you can't accomplish what you're trying to accomplish, though. All right. Another thing to be aware of too is, I kind of mentioned this a little bit as well, but obviously the older we get, the more the more at risk we are of our health deteriorating. So you do have to be in good health, not perfect health, okay, but you have to be in decent health. Because you're going to go through underwriting, right? There's going to be medical exams, blood work, and all that stuff. And again, just the longer you wait, the more risk you have of your health deteriorating, the less likely you are to get approved and maybe even be rated as well. So, this client is in very good shape. She takes very good care of herself. She doesn't smoke. So preferably be a non-smoker. All right. And if you smoke, you should stop anyways for your health. But if you stop smoking, that's going to help potentially with the rating of the policy as well. So these are just things to be aware of. We should be taking care of ourselves anyways, guys. I'm a big advocate for that. But specifically talking about life insurance, the older you get, the more your health is going to be potentially an issue later on down the road. So that's why you don't want to wait while you're in good health. You want to lock in that insurability because things eventually break down. Our bodies eventually break down. It is what it is. All right. And lastly, less time to compound. All right. So that's why, like, I did a video about, like, I was breaking down a policy I was setting up for a client for their for his child. And I mean, it's such a beautiful thing, like what these policies can turn into, the amount of wealth they can build the earlier you set these things up. Because guys, while 3 to 5% might not sound like a very sexy rate of return, and it's not, when you have true uninterrupted compound growth and you set these things up early where they can compound for decades, you'd be amazed at what those numbers look like. Like, true uninterrupted compound growth is incredible, right? So the earlier you set them up, the better. And so just managing expectations, all right? Obviously, if you're setting a policy up at 30 years old versus 60 years old, all right, the 30-year-old has an extra 3 decades of compound growth. So that policy is going to look a lot different, right? So it's just something to be aware of. Right, you're going to get less compound growth over time because you have there's less time involved, and that's the real power of compound growth is the time. More time we can give it, the more powerful it is. But with that said, again, that type of thing is really just a bonus. Like the compound growth within the policy is just a bonus, and the reason I'm bringing this up as a disadvantage is because sometimes when people are older and they look at the illustration and the numbers don't look like what they've seen in maybe other videos or other illustrations of people like setting them up earlier on. That's why. It's because you're older. But that doesn't mean these policies can't bring an incredible amount of value to your life. And like I said, typically we set these policies up in order to be able to utilize them. So we're setting a really strong financial foundation. We're setting that up. We're getting all these benefits from the policy, but then we're going to use the policy to build wealth like we normally would anyways, right? That's really why we're setting them up. So anyways, just wanted to answer that question, address that part of the infinite banking scenario, I guess, because obviously age and health is a big part of getting approved for these policies. So I just wanted to address that because it was really interesting. My client right here thought that she wouldn't be able to get her own policy because she was too old. She's not even old, right? But she still thought she was too old to set up her own policy and was trying to set them up for her son and then go through their policies, which you can do that. I guess that's another thing that I should mention too. If you are getting older and your health is deteriorating, but you still want to do this, you can actually still do it with by setting up a policy on a loved one. It's usually a spouse or sometimes a child. Depends on how old they are. But because you can be the policy owner and your spouse can be the insured. So if your spouse has good health, is younger, whatever, they can go through the application process. You can, or the underwriting process, I'm sorry, and you can be the owner. And when you're the owner of the policy and you're paying for the policy, you have access to the cash value. So you can use the policy to build wealth without you personally having to go through underwriting. Okay. So that's really important to take note of as well. So just because you're older and maybe your health is deteriorating, you can't qualify for life insurance, it doesn't mean you can't do this. If you have a spouse or a loved one that is definitely a possibility. So keep that in mind. All right. So anyways, I hope this helps, guys. If you have any questions, drop some comments down below. I'd love to hear your feedback as well. And if you want to have a conversation about this and discuss your situation, your goals, what you're trying to accomplish, to see if this might be a good fit for you, I will have a link to my calendar down below as well. All right. Hope you guys are crushing it, and I'll talk to you in the next one. To your success. Matty Ice is out.